Do you ever wonder how much tax rich people pay? You would be surprised to know that some of them pay as little as zero in taxes while earning $100 million annually. So, how is that even possible? Are they all tax robbers? Criminals? They are just very smart. They have figured out the loopholes in the tax system and use them to their advantage. They are evading tax legally. Now, some of you might be thinking, loopholes means what? It's basically an overlooked part of the system that gives someone a financial advantage. You can also call it a glitch in the system. Just like a glitch lets a hacker sneak past digital defenses, a tax loophole allows the wealthy to sidestep massive tax bills, all without technically breaking any rules. Not all people are smart enough to find loopholes in the system, but there are some accountants, often referred to as creative accountants, and tax lawyers who provide advice on how to legally bypass tax laws. Each country has a different set of tax rules and regulations, but here in this video, I will discuss the easiest legal and generic ways to reduce some of your taxes, no matter which location you are from. It is very likely you will find this video beneficial for you, or it will educate you on how loopholes work. Let's unpack some of the easiest and legal ways to reduce your taxes. First of all, millionaires buy their assets through their company so that they can deduct expenses related to that asset from their income to reduce their overall tax liability, like buying a car and writing off its fuel, depreciation, and repairs and maintenance charges. For example, if a millionaire buys a car through the company for $80,000 and each year they deduct $10,000 as depreciation, $5,000 for fuel, and $3,000 for maintenance, they are reducing their taxable income by $18,000 annually. If their tax rate is 35%, this results in a tax saving of $6,300 per year just for owning and using car through the company. Secondly, if you buy a property, rent it out, earn rent from it, and claim depreciation deductions from the rental income at the end of the tax year, it will reduce your net rental income and in the end reduce tax liability. There is a trick here. If you are claiming depreciation on your rental property, it will reduce its cost on your tax records. And when you are selling it at market value, you are supposed to pay higher capital gains tax. So what is the solution to it? Holding a property for long automatically reduces the capital gains tax at the time of its sale in some regions. And if you want to sell early, you can renovate it and make yourself eligible for adding up the renovations cost into the declared cost of the property, hence increasing its value. It will also reduce your capital gains tax. For example, Let's say you buy a house for $500,000 and claim $100,000 in depreciation over a few years. Now your tax adjusted cost is $400,000. If you sell it for $600,000, the capital gains is $200,000. But if you spend $50,000 on renovation before selling it, your cost becomes $450,000. Now your capital gain is only $150,000 and you are taxed on a lower amount and maybe at lower rate as well. Third thing millionaires do to save tax is making a trust. It's like shifting all of your income generating assets to someone else. Usually it is a registered authority and they manage the assets in your best interest and charge a fee against it to you. But how would it reduce someone's tax liability? In this scenario, the original owner of the asset is no more an owner of his own assets, but became a beneficiary among other beneficiaries of this trust. If it's a private trust, let's say in the end of a tax year, trust declares a particular amount of income and says it will retain a certain amount of income and distribute the rest of the amount among its beneficiaries. Now, each beneficiary is paying tax on its share of income, and you, as an owner, are not paying the entire tax alone. And if tax rates come with slabs like higher the income, higher the tax, solo owner is paying very high tax on a high amount of income. While if income is distributed, some of the beneficiaries may be declared tax exempt due to their income falling under the exempt tax threshold. Hence, the owner is not only saving income tax but also avoiding gift and inheritance tax in future while transferring assets to his family. Here is a demo. Let's say there is a trust which earns $100,000 in rental income. If the trust keeps all the income, the trust pays tax, often at a 37% top rate, which would be $37,000. But if the trust distributes $70,000 to beneficiaries, it deducts the amount from its income. The trust only pays tax on the $30,000 it retained, which is around $11,100, while the beneficiaries pay tax on their $70,000 share, often at lower individual tax rates. This spreads the tax burden and reduces the total tax paid. Another way to reduce tax burden is a trick called the Lenardo da Vinci trick. Let's say a millionaire earned so much in some tax year and is liable to pay a huge amount of tax. To reduce this tax liability, he will buy a very costly picture in some art gallery auction, enhance its value later, and then donate it to some museum. And guess what? This amount is now eligible to be considered as a deductible amount from his income in terms of donations, and hence it will reduce his tax. But wait a minute, he already spent a huge amount buying that image. How is it saving him tax? Because tax is usually charged in slabs like up to a certain threshold. Tax rates are different. By lowering the taxable income, a millionaire minimizes the overall tax rate as well. So let's say before buying a painting, he was liable to pay 45% tax on $100 million. After buying a painting worth $20 million and reappraising it at $40 to $50 million before donation, and assuming proper documentation and timing, the owner can deduct the entire appreciated value. His taxable income then reduces to $50 million and the payable tax may drop to 20%. That means he has saved $35 million in taxes. Tax rules and rates vary across countries and are often time-bound. So this entire scenario is hypothetical and not based on fixed figures. That's why proper tax planning is essential to execute this strategy. But it's a favorite trick among millionaires to legally reduce their tax burden. There is another trick that is used by millionaires. They run their business on loan rather than on personal money. How does it help in reducing the tax burden? For example, a millionaire borrows $10 million at 5% interest, paying $500,000 annually in interest. This interest payment is deductible from business income, which lowers taxable profit and hence reduces overall tax. There is another technique millionaires often use, like they have earned money and paid tax on that money, know where to save that money so it's not taxed again and can grow on its own. Like if they are putting it in a bank, they again have to pay tax on it. That is own profit on debt. So to avoid it, they invest it in shares where the tax rates are nil to very low. And their money is also growing as well. Some of you might already know a few of these things, and for others, this might be totally new. Either way, these are just a few examples of how wealthy people legally save on taxes. Some of the most casual ones. There's actually a lot more they do, but this is just to give you an idea of how tax planning works. This video is just for informational and educational purposes. If you are serious about planning your taxes, it is always a good idea to speak with a certified tax planner or consultant in your area. But once you understand how the system works, you will start coming up with smarter and more creative ideas on your own. Hope you found this helpful.